Welcome to the Nebraska Soybean Board Weekly Market Roundup, which is brought to you by Nebraska soybean farmers and their checkoff. I'm Susan Littlefield. As we know, another interesting week is taking place in the market trade, but a lot of outside market influence, as well as some interesting things that happened with the WASDE report when we look, for example, at Ukraine. We're going to find out those details and a whole lot more about this week's markets on this week's report.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
And welcome back. As you can see, joining me today is Jim McCormick and Brian Splitt. They're both with agmarket.net. And an interesting week. I mean, we had a lot of factors that were being worked into this trade, both from a grain and a livestock perspective. And then we just kind of put the frosting on the cake on a Friday with a WASDE report. So I kind of want to start there, gentlemen, with the WASDE. Kind of give us a rundown, first from the U.S. perspective on those numbers that you saw.
Yeah, I'll start. U.S. perspective, the yields were remaining unchanged, so the USDA didn't touch that. What they did do is they made some changes to the demand side of the balance sheet. On the corn, they reduced the corn for export by 50 million bushels, and they did that on the old crop. Now, to accommodate that, they did increase the food, seed, and industrial by 5 million bushels, so that gave us a 45 million bushel increase to carry out. Now, that would then translate directly into the new crop balance sheet, where they also increased food, seed, and industrial on the new crop balance sheet by 5 million bushels. So that added 40 million bushels to the new crop corn balance sheet. Now looking at soybeans, old crop demand was increased due to exports by 30 million bushels. That reduced the carryout on old crop, which then translated to a decrease in the new crop balance sheet as well. And we think that there's going to be some further adjustments made over the next month or two, because they did not touch the crush side of things. We have continued crush demand that's very stout, very good crush margins. And so we expect the old crop soybean balance sheet to tighten further over the next couple months.
Did you see any surprises when you looked at those numbers? I mean, anything that just initially jumped out, you saying, okay, I'm questioning what I'm seeing here?
I mean, for me in general, Susan, I think the trade was pretty much had a pretty good accuracy of what the number was going to be. I guess if you want to make the one argument you probably could have made was the corn number. They did cut that export a little bit. Some people in the industry do believe that you are going to have a better chance of seeing exports come back in a little bit. Plain and simple, you still have the problem with the Ukraine corn, getting that corn out of that country. You know, China was a buyer of about 6 million metric tons of corn that has not been able to get shipped out. You know, the question is, will these tighter supplies, you know, that essentially, because the world supply number actually got a little bit bigger, but the actual supplies available to consume are tightened up. Will that force some of those end users' hands in the United States who are trying to wait out for the new crop? But if the weather really gets bad, it may push them back into the market. So that might have been the biggest surprise for me.
Brian, I found it interesting. We were talking before this program even started, and you were talking about the both of you, the look but don't touch when it came to Ukraine and the information that was found in today's report.
Yeah, Susan. So one of the larger adjustments, and this was on the world side of the balance sheet, was to corn. And world corn stocks were increased by a little over 5 million tons. And that came straight away from an increase in production from Ukraine. And so that's kind of where you get to you can look at it, you can see it, but you can't touch it, because, you know, whether or not that grain and that extra production comes to fruition, time will tell. But it really doesn't matter to the world buyer right now, because it's not available. We can't get that grain out of the country. And so then we've got some compounding things moving forward, where in 60 days from now, if we don't see exports opening up in Ukraine, the producer will have limited cash flow. They won't have the cash from selling to the exporter. And cash flow issues may then impede some of the winter wheat plantings, which we would see between August and September. And if that's the case, that could limit the 2023 winter wheat production out of the Ukraine. So two angles there. You know, one was discussed on the report today, but one's kind of forward thinking as to what we may see or not see if we can get things opened up export wise in Ukraine, and if we don't, there's going to be some repercussions.
Well, Jim, what about for you when you look at South America and those numbers released from the USDA?
Well, right now, I think probably the biggest surprise was what they did with the corn crop out of Argentina. They didn't really make a big adjustment with it. There's a lot of people debating how late how the late season weather was for that crop. The top end might have come out. So that was probably pretty much the biggest surprise. But in general, I think the world's going to shift back to U.S. weather, and can we not get that grain out of the Ukraine? I do want to make one more note about what Brian was talking about the 23 crop. The big problem they're also going to get, Susan, is as we start harvesting this wheat crop, they'll be able to store that, but they've lost about 10 million metric tons worth of storage due to the war capacity. So in essence, if they can't get this wheat shipped out, then they get to the corn harvest this fall. There's no place to harvest the corn. Then you get the situation where they may choose or get forced to leave their corn in the field over the winter, which we know that'll degrade the quality and the crop size as well. So the clock is ticking for the world to try to figure out how to get that grain out of the country. And right now, the odds say it's limited that it will happen.
Well, as we continue here with the Nebraska Soybean Board Weekly Market Roundup, I'm broadcasting today from the Nebraska Cattlemen's Mid-Year Conference taking place in Valentine. And talking grain, and it was a discussion I had with a couple cattle producers here, gentlemen, was now's the time that they're thinking about locking in these feed costs as they look into later summer into early fall months. What are your guys' thoughts as you look at the overall grain demand from a global and a local? Is that a good idea for cattle producers?
Well, I think one of the difficulties for the cattle producer over the last several weeks has been we've seen the futures market back off, but the cash prices remain relatively stout. And so, if a producer was hedged on the board using futures where they were long, they may have experienced a break in their futures account where they've experienced losses, but the cash price hasn't changed. So it seems like maybe at this point that is not the strategy to use. It seems like maybe the option strategy where you kind of maintain a cap over the market in case we see something explosive futures wise happen in the next 30 to 60 days, but try to maintain more of a hand to mouth type of approach for the physical in the meantime. But you don't want to get caught long on the board and have the market break, but your cash market doesn't break. You're just adding insult to injury at that point.
Spread activity for grains. What are your thoughts on what we've seen this week?
Right now, we saw a lot of the old crop, new crop spreading come back to life. The July SEP spread really moved out. The July D's on the corn, the July Nov on the beans, and that really has to do with the tight cash supply we're seeing. Like Brian was saying, the cash market is really on fire right now, especially in the Western Corn Belt. There is a scramble to try to get the farmer who has grain left to move. A lot of the producers I have, Susan, right now, whatever they have left, they're going to hold tight until they get a further peek of what this weather looks like into pollination. And the maps right now are saying it could be a very warm, dry 40-day period, according to the latest European model. And that, I think, is just going to make it even that much harder to get that grain out of the farmer's hands, which should, I believe, help support those bull spreads.
The demand that's out there for this old crop, how much more pressure is that going to put on these producers to try to sell it if they keep inching up the price?
Well, I think the producer right now, like Jim said, they're waiting on a couple things. It's probably one of two. Either they want to see the weather pattern change and get to a point where they're more confident that we're going to get some cooler temperatures, but maybe more importantly, some precipitation in the forecast. Or number two, they just want to get a price that they haven't seen yet. So they may reward the market if they get a cash price that's above and beyond what they've already sold. Or if they feel like, hey, you know what, growing conditions look adequate, I think I'm going to have a good crop. I'll feel better about letting go of my last old crop bushels once I have a better sense of how my new crop production looks.
So, Jim, I'm curious. We talked about this a little bit before we started the program. Energy pressure, is it out of balance, and what's it going to take to try to even it out a little bit?
Right now, the biggest problem we've got is, when we started the pandemic, obviously the price of oil collapsed. It actually traded negative, you might recall. And that forced a lot of oil producing countries, not just the United States, but around the world, to cut production hard. Now they are bringing that production back online, but the reality is we're still not producing as much energy as we were pre-pandemic. I think even though oil rig counts, we're still about 100 oil rigs short of where we were. Part of that is just economics. They used to, for every dollar a crude producer used to make in profit, he put 90 cents back into the ground to expand production. They don't do that anymore. It's usually more like 50 cents they keep back and give back to the shareholders. So the shareholders are demanding a little bit better return. But the other problem is just a labor shortage around there. It's just hard to find people to work. in these oil fields right now. So that's going to take time to build that up. Eventually, price will bring it up. That's just part of one part of the problem. Excuse me. The other part is demand. After 2 years of being stuck at home, just consuming stuff, maybe buying stuff on, Amazon, people are tired of that. They want to go on vacation. And if anybody's traveled, even when you flew anywhere, you realize the airlines are completely full. People are flying, even though the cost to get there is extremely high. They're driving no matter what. If you looked at where we were, driving was quite a bit higher over Memorial Day than it was just the last couple of years. So you've got a demand sector that normally would be rationing out by these higher prices. It's just not happening yet. I think eventually you'll get their combination of the high prices will get people off the road and it will increase production, but it's going to take time. And that's going to make it more expensive for the livestock producers to move cattle to market, but it's going to be more expensive for everything, getting products to the grocery store. And it could get really, really expensive, unfortunately, for the grain producer this fall in moving the crop out of the field to market, but potentially drying it as well, because the crop is off to such a late start. We potentially could have a late fall. If we happen to have a wet fall, it could get very, very costly drying this crop down.
I think talked about what is going to happen at some point, which is the energy values are going to have an impact on demand in the big picture. At some point, we're going to start rationing that. And then also with the high prices, we're going to see production come back online more earnestly. So as those two things happen, we're going to go back in the other direction. Now, if we put a potential recession into the mix here, and that's been one of my fears over the last several months. So if you're trying to be patient and look for this weather market to bring higher values, I still advocate for carrying puts under the market for the just in case.
Well, thanks so much for both of you joining us this week. We want to remind folks that commodity futures and options involve a substantial risk of loss that isn't suitable to all investors. And that's been the Nebraska Soybean Board Weekly Market Roundup, being brought to you by Nebraska soybean farmers and their checkoff.